Well, welcome to a very important day on the National Real Estate Cafe. How about that? It rhymed.
Very good.
And today's a big day. This week is a big week because we've all been waiting to see what the Fed is going to do.
And, you know, what we're looking for is the Fed to make a decision on short-term interest rates. I want to be very clear about that, is this is the overnight rate that they charge. And it does have an impact on your prime rate, which is tied to home equity lines of credit. It has an impact on the cost of borrowing for banks, which sometimes makes it to you through the general economy on credit cards and other things.
Auto loans and so forth.
But it doesn't have a direct correlation with mortgage rates. It does have an impact, but not a direct correlation.
So what is the Fed going to do? Well, we both agree that the Fed isn't going to do anything at this time. Now, can they at October or December? Everybody's kind of banking on December. What was the number? 76% of the experts agree with us?
76% agree that this time we won't see the Fed take action. Now, here's something interesting that I haven't heard yet on the news anywhere is there's always the speculation that the Fed's going to move in quarters. However, the last thing that Janet Yellen said was they're going to move at a moderate pace. The X factor, what I would like to see that would actually, I think, please all sides of the market is if they moved half that right now, it would be okay. If they moved 1/8%, I think that would be a good sign to say, hey guys, we're going to move, but we're going to move slow.
I don't think they're going to waste their time. If they're going to do it, they'll do it a quarter, which is still fairly moderate. And we're at the lowest interest rates we've basically seen in our history. So we don't think it's going to change. And 3 out of 4 dentists agree with us. Okay, here's some numbers of why we feel that there's not going to be an adjustment, because it has to do with what's going on in the economy.
Yeah, and the economy is generally strong. I see a lot of the parts of the market booming. But there's some parts just showing some softness, and we haven't determined whether that's seasonal softness yet, but a couple of the reports were the worst reports we've seen in years, Don.
That's right. So retail sales, not bad, but not too exciting. We expected a 0.3 increase, was 0.2. So nothing really showing that, an ugly head there. But this next slide, the Empire State Manufacturing Survey, not so pretty.
And Don mentioned to me that this is the second report in a row on the Empire Manufacturing Index. Now we're showing 2 reports in a row. The early phases of a trend, as Don and I like to talk about trends. We're going to continue to monitor this because this is the worst number since 2009. So are we cutting back on manufacturing because of what's happening in China? Who knows?
Yeah, that's a good point. So that is a precursor to what inflation, because if we are not manufacturing as much, well, then maybe they don't have to charge as much. Here's another number that will, support this just as well. Industrial production.
Yeah, we have more capacity than we know what to do with, right? And this could lead to layoffs. And we're seeing that this particular report says we have more capacity now than we did before. So again, supporting low inflation because we have more capacity and potentially supporting layoffs. So proceed with caution because of this report.
Yeah, and then big report coming out today, the CPI report, which also measures inflation. Now that's we don't know where that's going to head. We think it may be a little higher, which will make it a big deal, but it's only higher because it compares year over year. And last year at this time, it was dismal. So any number is going to make it look a lot more, but we really don't see a lot of inflation in the horizon.
No, so that's one report, not a trend. So we just have to watch the CPI gauge, even though that's what the Fed is looking at. They're looking at a number of factors, especially jobs.
All right, so how's it affecting interest rates? Yay, yay, yay. A lot of people are afraid because they don't know what the Fed's going to do. They're waiting. And again, like Gino said, that what the Fed does not affect mortgage rates directly, but it does indirectly because everybody's waiting to see what's going to happen and how fast the interest rate may rise in the future. So
truth of the matter is, rates got worse. They got worse quite a bit the last couple of days. But we expect to see a bounce back once we see what kind of action we take. It's just a fear-based reaction, just a quick move, a protectionary move from investors, making sure they protect their hundreds of millions of dollars that are in bonds.
Exactly. If you see this chart here, thank goodness from MBS Highway, they do a good job, but all those arrows are support lines. Those are support arrows, basically saying we should have a pretty strong support where it should bounce up. No guarantees, because the Fed is the X factor. So we'll find out a little bit later this week, and be sure to tune in to text NREC to 5885, because we will send an update as soon as we hear what the Fed's decision is and could help you know what's going on. So make sure you tune in daily to the National Real Estate Cafe. Check us out at NRE Cafe. I always mess it up. NREcafe.com to find out what's going on, and tune in daily, and we'll update you again soon.